Welcome to this explainer. Okay, if you're running a business here in Canada, you've definitely faced this. It's like the ultimate headache-inducing dilemma in commercial finance. How exactly do you get your hands on the expensive equipment you need to grow? Do you just drain your hard-earned cash reserves to own it outright? Or do you sign on the dotted line and pay interest on a lease? It's a high-stakes choice, and honestly, it can absolutely make or break your balance sheet.
Okay, let's dive into this. This really isn't just some simple math problem. It's a strategic move that hits right at the core of two massive pain points for basically any operator: cash flow constraints and, of course, the notoriously complex Canadian tax code. Getting this wrong? Well, that means tying up capital you might desperately need next month, or literally missing out on massive tax deductions.
So to give you the full picture without getting bogged down, here's our roadmap. First, we'll look at the equipment financing dilemma. Second, buying and CCA tax rules. Third, the tax power of leasing. Fourth, we'll explore the hybrid equipment strategy. And finally, we'll wrap up with the sale-leaseback maneuver. We're going to logically walk through these tax structures piece by piece so it doesn't feel overwhelming.
All right, kicking things off with Section 1, the equipment financing dilemma: cash flow versus equity. The primary trade-off Canadian business owners face really just comes down to this tug-of-war between cash flow and equity. See, when you buy equipment with cash, you're building equity. You own the asset, it sits right there on your balance sheet, and over the life of the equipment, it's generally cheaper because you aren't paying administrative fees or interest rates. But, and it's a big but, you severely deplete your cash reserves. Leasing, on the flip side, preserves that immediate cash flow. It keeps your working capital safe and sound in the bank for emergencies or making payroll, even though, yeah, it is going to cost you more over the total term of the contract. Moving on to Section 2. Buying and CCA tax rules. Let's navigate CapEx. Now, what's really interesting about this concept is what happens if you actually decide to buy equipment outright. Welcome to the wonderful world of capital expenditures. And here's a massive reality check. A lot of business owners assume that if they drop, say, 50 grand on equipment, they can just deduct 50 grand from their taxes in year one. Actually, scratch that, you absolutely cannot. Under the CRA's capital cost allowance system, you have to deduct that cost gradually, over many years, using very specific depreciation classes. Basically, the CRA breaks equipment down into different CCA classes, and each one dictates exactly how fast you can write off your purchase. For instance, standard tools or miscellaneous kitchen equipment, those fall into Class 8, letting you claim 20% on a declining balance. Now, if you're buying manufacturing machinery, that might be Class 43 at 30%. Or if it's enhanced manufacturing equipment, Class 53 allows a 50% rate. So as you can see, it's really a slow, long-term tax write-off. But there is a silver lining. The government currently offers a temporary boost called the Accelerated Investment Incentive. Now, normally, the CRA applies this half-year rule to new equipment, which just means you only get to claim half of your usual CCA rate in that first year. But for eligible property acquired before 2028, this incentive essentially suspends that half-year rule. It basically gives you an enhanced first-year allowance that can be up to 3 times the normal first-year deduction. It's a huge bump. Just keep in mind, though, a phase-out of this measure has already begun for property available for use after 2023.
All right, Section 3, the tax power of leasing. Let's talk about preserving your working capital.
If all that complex depreciation math of buying outright doesn't exactly sound like a good time, well, leasing has a superpower. And this is especially true for small businesses and startups. It preserves your immediate working capital. When you lease, the payments are generally treated as an operating expense, or OPEX, meaning those lease payments are typically 100% tax deductible in the exact year they're paid. Plus, instead of handing over a massive lump sum of GST or HST up front like you do when buying, you just pay sales tax gradually on each monthly payment. That lets you claim input tax credits smoothly over time. It's a structure that perfectly aligns your monthly expenses with the actual revenue the equipment is helping generate, and you completely sidestep those headache-inducing CCA depreciation schedules.
Let's actually ground this abstract tax theory in reality for a second. Imagine you're looking at a hypothetical $15,000 commercial oven. If you buy it with cash, your upfront cost is 15 grand. Your total cost over 5 years is exactly 15 grand. But your retained capital, the cash actually left in your bank to run your day-to-day business, is zero. Now, if you lease it on a 5-year term, you might only need, say, $600 upfront. Yes, your total cost over time is going to be higher, maybe $21,000 to $24,000 due to interest, but look at that retained capital. You keep $14,400 in your bank account on day one. For a growing business, honestly, that kind of liquidity is a total lifesaver. moving right along to Section 4, the hybrid equipment strategy, passive iron versus revenue iron. You know, what if you don't actually have to choose between just buying or just leasing? Top Canadian chains use what's called a hybrid strategy, and this brilliantly illustrates the whole concept. It's about looking at your equipment list and dividing it into two very distinct categories based on what actually impacts your bottom line. We call these passive iron and revenue iron.
First up, you buy your passive iron. These are basically your dead assets. We're talking things like stainless steel prep tables, sinks, basic shelving. They're super durable. They'll easily last 20 years. But let's be real, a stainless steel sink isn't magically generating profit on its own. So paying interest on a lease for a sink, that just eats into your overall margins. This is exactly where you want to deploy your cash.
But then, on the flip side, you lease your revenue irons. These are your absolute profit engines. Think of a commercial soft-serve machine or a specialty high-volume fryer. A leased machine like that might cost you maybe $800 a month. But because it's driving sales directly, it can easily generate a staggering $3,000 in pure monthly profit. It is just a beautiful example of profit arbitrage. As one industry source perfectly frames it, the machine pays for its own lease payment in the first 3 days of the month. The remaining 27 days are pure profit. Seriously, think about that. You really shouldn't be tying up $25,000 of your own cash when the machine is more than capable of paying its own monthly bill, all while leaving you with thousands in pure profit.
All right, bringing us to Section 5, the sale-leaseback maneuver, unlocking hidden asset value.
Now, what if you've already bought equipment, your cash is completely tied up, and you suddenly realize you need capital right now? Well, here is a bit of a secret weapon. Step 1, you sell your fully owned equipment directly to a leasing company. Step 2, the leasing company hands you an immediate cash injection based on the current value of that equipment. And Step 3, you simply lease that exact same equipment right back from them. The gear literally never leaves your facility. You just managed to turn an illiquid physical asset into instant working capital, and bonus, your new lease payments are 100% tax deductible. It's essentially an off-balance sheet cash injection.
However, just to be completely objective here, a sale-leaseback isn't some magic wand for every single situation. It is definitely not the right fit if you only need the equipment for a short term, like anything under 3 years. It's also not really viable for rapidly depreciating assets whose value is just going to plummet, and it's generally not ideal for hyper-growth businesses that are probably going to outgrow their current gear in a matter of months anyway.
So the crucial point is that there's really no universal, one-size-fits-all right answer when it comes to leasing versus buying. Making the correct choice requires you to carefully balance your immediate cash flow needs against your desire for long-term equity, all while navigating those CCA tax implications or OPEX deductions to figure out what actually makes the most sense for your specific revenue model.
I want to leave you with this one thought to chew on. Take a really hard look at your own operation today. If you were forced to categorize every single piece of equipment you rely on, what is your passive iron and what is your revenue iron? Knowing the difference might just be the exact key to unlocking your smartest Canadian tax strategy yet. Thanks so much for joining me on this explainer, and hey, keep optimizing.